$500,000 in revenue, clients lined up, a wait list, and on a random Tuesday in October, the owner cannot make payroll. Not because the business is failing, not because the product is bad, not because anyone did anything wrong. The business is doing everything right, and it is still about to go under. Here is the part nobody tells you when you start a business: revenue is not money, sales are not cash. And profit, that number your accountant smiles about, means absolutely nothing if the actual dollars are not sitting in your account when the bills come due. Most small businesses are not killed by bad ideas or lazy owners. They are killed by a timing problem so invisible, so counterintuitive, that most people never see it coming until it is already too late. Stick with me, because by the end of this, you are going to look at every dollar your business makes in a completely different way. According to the U.S. Bureau of Labor Statistics, roughly 20% of small businesses fail within their first year. By year 5, that number climbs to nearly 50%, and the number one reason, cited in study after study, is not bad product, not bad marketing, not wrong timing. It is this: they ran out of cash. Not ideas, not customers, cash. And what makes that genuinely terrifying is that a huge chunk of those businesses were profitable on paper when they died. They had revenue coming in, real customers paying real invoices. They were not broke in the traditional sense. They were broke in the timing sense. And those are two completely different kinds of broke. One means your business is struggling. The other means your business is actually working, just not fast enough to outrun its own expenses. That distinction is what most people completely miss. And right now, with inflation still squeezing margins and customers taking longer than ever to pay, the gap between the money you earn and the money you actually have has never been wider. That gap has a name, and it is quietly suffocating businesses that, by every other measure, should be thriving. Meet Marcus. Marcus is not a character from a business textbook. He is the guy you know, maybe your cousin, maybe your neighbor, maybe, if you are being honest with yourself, Marcus is you. He started a small commercial cleaning company in Atlanta 3 years ago with a secondhand van, a Venmo account, and enough hustle to outwork everybody in his zip code. By year 2, he has 6 employees, steady corporate contracts, and a revenue number that makes his old coworkers do a double take at cookouts. And then, one Thursday afternoon, Marcus lands the contract. A large office complex, $42,000 a month, guaranteed. He is ecstatic. His wife is ecstatic. LinkedIn goes crazy. This is the moment. So Marcus does what any growth-minded business owner does. He scales immediately, hires 4 more people, buys supplies in bulk, upgrades his equipment, spends roughly $30,000 getting ready to service this contract. And why not? $42,000 a month is coming in. The math is obvious. Except, here is the part LinkedIn never shows you. That contract pays on net 60 terms. Meaning, Marcus does the work in January and gets paid at the end of March. He does the work in February and gets paid at the end of April. He is delivering 5-star service every single week while the money he already earned sits somewhere in a corporate accounting queue with zero urgency behind it. Meanwhile, payroll does not run on net 60. Payroll runs on Friday. And his bank account, the one that is supposed to be filling up with all this success, is draining. Let's run the actual numbers, because this is where the story stops being a story and starts being a warning. Week 1, Marcus deploys his expanded crew. Supplies, labor, fuel, equipment payments, roughly $18,000 out the door. Week 2, same thing. He has now spent $36,000 and collected exactly zero from the new contract. Week 3, some money trickles in from his older, smaller clients, maybe $12,000. He exhales for about 4 hours, then checks what is still owed before month end. Rent on the warehouse, equipment financing, payroll again, insurance renewal he forgot was coming. His account, which had a comfortable cushion 3 months ago, is now sitting at a number that makes him feel physically sick. And the $42,000 he already earned, real money on a signed contract, will not arrive for another 4 to 6 weeks. That is the timing trap, not a cash shortage, a cash timing problem. The difference is enormous. A cash shortage means your business is not making enough money. A cash timing problem means your business is making plenty of money. It just has not landed yet. And here is what should genuinely make you uncomfortable. Banks do not care about signed contracts when you miss a payment. Landlords do not accept invoices as rent. The economy runs on actual dollars in actual accounts at the actual moment the bill is due. Here is where it gets structural. Marcus's situation is not a Marcus problem, it is a system problem. The entire way American business operates is built around payment terms: net 30, net 45, net 60, net 90, which is just a professional way of saying, we will pay you when it is convenient for us. Large corporations use these terms deliberately to protect their own cash flow, to hold onto their money longer, to keep their own books looking healthy, while the small contractor who did the actual work floats them an interest-free loan for 60 days, completely legal, completely normalized, and almost never questioned. And then there is the growth irony, which is genuinely one of the most counterintuitive truths in all of small business. The faster you grow, the worse your cash flow problem gets, at least in the short term. Because growth costs money before it makes money. Every new hire, every bulk order, every equipment upgrade comes out of your account today. The revenue it generates shows up months later. The reward for winning in the short term is running out of cash faster. So what does Marcus actually do? First thing, negotiate payment terms before signing any contract, not after, before. Net 60 is not a law, it is an opening offer. Most small vendors never push back. When you do, professionally and calmly, net 60 quietly becomes net 30 more often than you would expect. Or you get 50% upfront with the balance on delivery. That one move alone can cut your cash flow gap in half before the work even starts. Second, milestone billing. Invoice at every significant checkpoint instead of waiting until the end of the project. You stop waiting for the finish line to get paid and start getting paid while you run the race. Third, a real cash flow forecast. Not a revenue goal, not a profit projection. A week-by-week map of exactly when money is coming in and exactly when money is going out. Most owners have a general sense of this. General sense is not good enough. You need to know about a cash gap 14 days from now while you still have time to do something about it. Marcus made it, by the way. Renegotiated his terms, restructured his billing, and clawed back onto solid ground. It cost him 6 months of stress that no LinkedIn post ever mentioned, and 2 employees who could not wait while he figured it out. He survived. Most people in his exact situation do not. So here is the question worth sitting with. If every client you have decided to pay you 60 days late all at once, starting tomorrow, how many weeks could your business actually survive? If that answer came quickly and confidently, you are in rare company. If it made you uncomfortable, if you found yourself doing rough math and not loving where it landed, then you already know what the most important work in your business is right now. It is not the next client, not the next product, not the next launch. It is that number you just thought of, and what you are going to do about it before it decides for you.